help me understand the dollar milkshake theory, because you've been kind of explaining this and pushing this for quite a while. We've seen it, really play out how you called it. But what exactly is that dollar milkshake theory?
Well, so first of all, I'll say I appreciate you saying that I've called it right. I don't know if I've called it completely right, but it's on the right track. Somebody asked me the other day where they thought I was at, using a football analogy, and I said I thought I was just over midfield, maybe around the 40 or 45. It's heading in the right direction. So far, it's playing out the way we thought it would play out. But this is a big game, and it's a long game, and I don't have any illusions that it's going to be easy from here on out. It's probably going to be pretty challenging, but I think the opportunities are enormous. Essentially, I'll start at a very big picture level, and then I'll try to get more detailed on the dollar milkshake theory. But essentially what it is I think that we're going to go through the biggest short squeeze in history. And what I mean by that is I think the US dollar is going to get squeezed much, much higher. And it's going to get squeezed much, much higher because despite the fact that many people don't like it, would prefer to have an alternative, that they just don't. And the rest of the world, the U.S. and the rest of the world has taken out an incredible amount of U.S. dollar debt. That debt either gets paid off, serviced, or defaulted on. And the only way that isn't extremely dollar positive is if it gets paid off. I don't see how it can get paid off. There's just not enough dollars to go around. But the demand just to continue to service it continues to put a bid under the dollar. And if it gets defaulted on, defaults, while it may decrease demand, it actually destroys money. And what I mean by that is in a debt-based monetary system where money gets loaned into existence, a default actually makes money disappear. And it starts a chain reaction all the way back to the collateral, which was the original basis of which everything was loaned into existence. So even if you have defaults where demand falls, supply falls even faster. So whether people continue using the dollar and are able to service it, I think that puts a bid under it. Or if they start defaulting on it because they can't pay it or don't want to pay it, we get a supply shock and the dollar goes higher. I can't figure out a scenario. Actually, I can figure out a couple potential scenarios where it would go lower, but I just think those are very low-level probabilities. And because I'm so adamant about it, or because I'm so convinced of it, that's probably why I've been that's why I've been pounding the table on it as much as I have. Not so much because I want to be right. I mean, don't get me wrong. I want to be right. I'm in this to make money. I'd be clear. That's my job. My job is to make money. I want to be right and I want to make money. But if I just wanted to make money, I'd just be quiet and, not say anything. But one of the reasons I'm as vocal as I am about it is I think it's one of the biggest problems existing today. And I actually want to help people. I want to help people understand what's happening so that they can understand how maybe they can position their self as we go through this. And even if they don't believe in it, and even if they don't agree with it, at least if parts of it become true, they can kind of understand why it's happening. And so that's kind of the genesis of the idea. It's why I think it's such an important idea, and it's why I've been so vocal about it.
Got it. And I've heard you describe kind of the actual milkshake component of it as, other countries injecting liquidity and kind of making the milkshake, but the U.S., rather than having the ability to inject the liquidity, having a straw. Maybe kind of cover that, because I think it's a really good way of articulating, how this plays out. Yeah.
So I'm happy to answer that. And I'll say it's really interesting that you asked this at this point, because over the last, especially over the last couple of months and definitely over the last year, I've been accused of changing my story. And it's funny because on one hand, I get accused of changing my story. And then on the other hand, I get accused of being so stubborn and never being open to new ideas. So it's a little bit of a mixture there. But when this initially started a couple of years ago, I should tell you, I used to run a gold fund. And I don't have time to go through the whole story of why I used to run it and why I no longer run it. But essentially, I ended up shutting it down because I was not able to raise enough capital to make the fund structure through which I was running it economically viable. It was too expensive for clients. And I didn't think it was the appropriate thing to do. So we shut it down. We still own gold for clients, but we just don't own it in this structure anymore. And part of the reasons I shut it down is I didn't think, or I did a big study on the dollar and gold. because I was trying to figure out why was gold staying in this bear market. Most of my thoughts were that gold should be going higher and the dollar should be going lower, and it just wasn't. And I fought it for a long time. I was very stubborn. And finally, I just said to myself, something I'm missing here. I got to figure this out. And so I kind of did this big, deep dive on my thesis. And to be honest, I didn't like the answer I came up with, because the answer I came up with was that the dollar was going to go a lot higher. And typically in the gold world, one of the core tenets of being a gold investor is you think the dollar is going to zero. And so, but what was also interesting is the more I studied it, the more I became convinced that the dollar would go higher. But I also thought the gold would go higher with it. I thought there might be an interim period where the dollar would rise, gold would fall. But I became more convinced than ever that we'd get to a period where they would rise together. And so as I started doing all of this work on the dollar and why I thought the dollar was going to go get higher, the more I got into it, the more it became clear to me. And that's when the milkshake analogy came up, because there's this famous movie called There Will Be Blood. I don't know if you've ever seen it, but it's about this oil baron, this really cruel oil baron, and he's just ruthless. I mean, he'll just do anything to get one up on his competitors. And kind of at the end of the movie, he's talking to one of his competitors, and his competitor says, I'm not going to sell my oil to you. And he says, well, it doesn't matter. I'm going to stick a straw, across your fence down into your ground, and I'm going to suck it all up, So whether you give it to me or not, I'm going to drink your milkshake, is essentially what he says. And the more I started studying the global monetary system and where I thought capital flows would go over the next couple of years, the more I became convinced that due to a number of factors, the U.S. was going to suck that capital into the United States. So it didn't matter where that capital originated. It could be on my side of the fence or the other side of the fence. All I got to do is stick a straw down in there to all that liquidity and suck it up. And so how that related to the dollar milkshake theory that I was talking about in my world, as opposed to this movie, was that over the last 10 years, since the global financial crisis, we all know that the Fed came out and did QE in these bailouts, and they pumped the economy full of liquidity, right? But it wasn't solely a U.S. phenomena. The Bank of England did it, the ECB did it, the BOJ did it, the Chinese did it, Canada, bailed out their housing market. So the whole world got behind this injection of liquidity, and for the first 5 years, we all did it in unison. From 2009 to 2014 or 15, everybody was injecting. It was a coordinated monetary policy. But in 2015, the U.S. stopped, and the U.S. started raising interest rates. And when they raised it the first time, I was pretty skeptical. But when they raised it the first time and the market didn't crash, because a lot of people thought as soon as they raised interest rates, the market was going to crash. And I was probably initially maybe not completely on board with that, but I would not have been surprised if that happened. But when it didn't happen, that's when I really kind of started, when I said I did this kind of deep dive. And what I decided was that there actually was one scenario under which we could continue to raise rates, even though the rest of the world wasn't. And so I thought that over the next couple of years that we would get rate hikes. And so that's when I started talking about, as we take our syringe away and we no longer inject liquidity, we stick a straw down in there, and as we raise interest rates, that pulls capital into the United States. Now, that was the analogy I used most because that was the predominant reason that I thought capital would flow into the U.S. was interest rates. But that's not the only reason. There's many reasons that I thought capital would flow into the United States. One was, Trump was a big part of this. Trump did a lot of deregulation, made it more attractive for capital to come in. He did a number of tax deals, which made it an attractive place for capital. The fact that we were growing faster than the rest of the world, or in many other places of the world, look at especially in Silicon Valley, it made it a very attractive place for capital to flow. And I just, and because it's the world reserve currency, people have to use the dollar for transactions. It places kind of a natural bid under the dollar. If you're going to hold reserves and you can hold them in, it makes sense to hold it in the dollar. Well, then why not also hold, treasury bonds or U.S. real estate or U.S. asset or stocks? So for all those reasons, I thought that the U.S. would suck that capital into the United States. Now, in 2018, I'm going to get my years messed up here a little bit. Maybe it was 19. But anyway, I thought so we got 9 interest rate hikes. Most people didn't think we would get 1 or 2, but we got 9 of them. And the whole way up, people were saying it's going to crash the economy. It's going to crash the economy. Well, it finally did. And I actually thought that we would get a couple more interest rate hikes than we did, but I was wrong. We didn't get those last 2 or 3 that I thought we would get. And I kind of admitted it fairly quickly. I said, you know what, I was wrong. They're changing their tune. Powell kind of did a 180, stopped the quantitative tightening. But even though they stopped the quantitative tightening and they actually started lowering interest rates, it didn't mean that we were not still an attractive place for all those other reasons that I mentioned. And I kind of got to a place. I have this channel of the S&P 500 that I've been following since 2009, really. And it's usually kind of bounced around in that channel, but went higher. And we got to the very top of that channel and actually peeked our head out of the top of the channel a little bit. And I kind of thought we'd kind of overdone it. I thought we would get a pullback. Now, I didn't think we would get this big of a pullback. I thought we might get a 10% pullback, 15% pullback. I wasn't quite expecting a 25 or 30% pullback. But here we are. And now everybody's printing. The whole world is printing. We're printing, but this, and then people will say to me, well, isn't this going to kill the dollar? Well, if we were acting in a vacuum, it absolutely would. But this is also very similar to 2009 when we announced QE 1 and 2 and 3 back in 10 years ago. A number of institutions and people around the world thought that the United States dollar would fall as a result of that. If you think the dollar is going to fall, one of the smart things to do is you take debt out in that currency, and as it gets inflated away, you pay it back at a lower price later on. Well, the rest of the world borrowed $13 trillion in US dollars. I think it was around 4 or 5 trillion in 2008, and now it's another 10 trillion since then, 9 or 10 trillion since then. But the problem is that the dollar didn't get weaker over that time. The dollar actually got stronger over that time. And so now we're back in the same situation. We owe a lot of debt, but the rest of the world owes 13 trillion of a currency that they can't print. And we're in a situation where asset prices are falling. And it's when we talked about asset prices falling, it makes money disappear, because when money's loaned into existence and you have defaults, money gets destroyed. So now you still have this high level of debts that need to be paid off, but the supply of dollars is shrinking. It's deflation, right? And so we're going through a massive deleveraging event right now. And so now all the central banks of the world again are coming out and printing like crazy. And listen, the Fed is printing like a madman. I'm not denying it. But the ECB is too. The Bank of Canada is too. China is too. Australia is too. Brazil is too. Everybody. So now we're back to this coordinated effect again, right? Everybody's providing liquidity. I just happen to believe that it doesn't really matter where that liquidity gets injected. Whoever has the straw gets to suck up that liquidity. Now, on a relative basis, despite the fact that we've cut rates all the way down, they're still basically the highest in the world, other than maybe China. And again, I don't think people are racing to put money into China right now. I don't think the Russian ruble is going to become the world reserve currency anytime soon, right? So while our rates are certainly not as high as they were 2 years ago, on a relative basis, they still look pretty good, but all those other factors are still attractive for capital to come into the United States. And I think the fact that we are still the world reserve currency combined with those other factors will draw capital into the United States over the next couple of years. And I think drawing in that capital will keep the dollar stronger than other fiat currencies, despite that we're printing so much of it.